3 months ago, 120 ships a day sailed through a corridor of water just 33 kilometers wide. Today, fewer than 20. Some days, 5. That corridor is the Strait of Hormuz, 1/5 of the world's oil, 1/5 of the world's liquefied natural gas. And since February, it has been, effectively, closed. The International Energy Agency calls this the largest supply disruption in the history of the oil market. Bigger than 1973, bigger than the Gulf War. Here's what nobody's telling you. Even when it reopens, and it will reopen, the world that depended on it isn't coming back. I'm Atlas. This is the Chokehold. And this is the endgame.
First, the mechanics, because a strait doesn't close the way a door does. On February 28th, the United States and Israel began striking Iran. Iran didn't answer by sinking a fleet. It answered with drones, missiles, and small attack boats, just enough to make every insurer on Earth do the math. And the math said no. War risk premiums went so high that a tanker voyage stopped making commercial sense. No insurance, no crew, no transit. Iran didn't have to win a naval battle. It priced the strait out of existence. If you want to know how the next choke point crisis unfolds, that's the lesson. Watch the insurers, not the navies. Quick aside, if this kind of analysis is useful, subscribing takes one click. One map at a time, you'll see these patterns before the headlines do. Now, here's the twist. For the first 6 weeks, one country kept shipping oil through Hormuz just fine. Iran. About 2 million barrels a day, mostly to China. So, on April 13th, Washington answered with a naval blockade of Iranian ports. By late May, American forces had turned back over 100 vessels. Iranian exports collapsed from 1.6 million barrels a day toward 500,000. And then Iran did something genuinely new. It started charging admission. The Revolutionary Guard now runs what amounts to a toll booth, about $1 per barrel, $2 million for a single supertanker, with safe passage sold preferentially to friendly flags. A handful of Qatari gas tankers have slipped through. Everyone else waits. Think about that precedent. If Tehran can tax a choke point the US Navy spent 50 years keeping free, what does Malacca cost in 20 years? Gibraltar? The Danish Straits? That question outlives this war.
So how big is the hole? Let's run the ledger.
6 Gulf producers went from 24 million barrels a day to about 12.5. Nearly 12 million barrels a day, shut in. After pipeline workarounds, the world is still short roughly 9 million barrels a day. In 3 months, the cumulative loss passed 1 billion barrels. That's 2.5 American strategic reserves, gone. And the meter adds 350 million barrels for every month this lasts. The workarounds are real, but they're a garden hose on a house fire. Saudi Arabia's east-west pipeline is running flat out, 7 million barrels a day to the Red Sea. The Emirates line to Fujairah moves another 1.8. Together, the bypass routes peaked above 7 million barrels a day in early May, and then a strike hit the Fujairah terminal, and they fell back under 5. The lesson: bypass infrastructure is also a target.
Who's bleeding?
Iraq, worst of all. Its exports go through Hormuz, or they don't go. Oil revenue, $6.8 billion in February. $1 billion in April, and its giant, aging southern fields can't just be switched back on. Lose reservoir pressure for long enough, and some of that production never comes back. Rystad's analysts already classify part of these losses as permanent. Qatar, the world's LNG superpower, has been functionally erased from the spot market. Gas tankers through Hormuz went from 5 a day to nearly 0. Unlike oil, gas has no pipeline workaround here at all. And you, watching this, you're paying for it at the pump. $4.30 a gallon in the US, because oil is one global pool. Being the world's biggest producer doesn't exempt America from the price. It never has. The only thing standing between this and far worse is the largest coordinated reserve release in history. 400 million barrels, adding about 3 million barrels a day. The IEA's own chief says that cushion runs dry around July or August. The clock is loud. Now the uncomfortable part. Every chokehold has a beneficiary. Follow the rerouted barrel. Saudi Arabia first. Its pipeline to the Red Sea turned a catastrophe into market share. $24.6 billion of exports in March, its best month in 4 years. Riyadh is hurting less than its neighbors and quietly proving it can live without the strait. American producers second, slowly. Frac crews in the Permian are at their busiest in a year, up 20% in weeks. US barrels and US gas now look like the world's safest supply. And every LNG contract Qatar can't fill is a contract Texas and Louisiana can. Russia, third, the quiet winner. Higher prices for its own crude, a distracted Washington, and buyers suddenly very interested in any barrel that doesn't touch the Persian Gulf. And the map itself is shifting. Cargo that used to ride the Gulf is crowding secondary choke points, the Panama Canal, the Trans-Caspian Middle Corridor. One door closes, and the pressure redistributes through every other narrow point on Earth. That's not a detour. That's the next decade of geopolitics being drawn in real time. One more casualty. OPEC. The Emirates walked out of the cartel on May 1st. Gulf production is down 30%, and the quota system is fiction now. The organization that managed oil prices for 60 years may not survive this in any meaningful form. So, the call. The optimistic scenario floating around trading desks, Rystad's base case, says a narrow US-Iran deal lands in June. The strait phases open from mid-July, and most flows are back by October. There was even a memorandum on the table last month. It fell apart. Strikes on Iranian energy facilities resumed this week. So here is the chokehold's prediction, with conviction. The strait does not reopen on the summer timeline. Expect a phased, escorted, insured reopening to begin in the fall at the earliest. And expect reopened to mean tolls, convoys, and conditions, not the free passage of 2025. By year-end, the world will have lost close to 2 billion barrels, and pre-war flows never fully return. Iraq's lost fields, the Emirates' expanded bypass to 3.3 million barrels a day, Qatar's spooked customers signing 20-year American gas contracts, OPEC's fracture, those are permanent. The choke point era didn't peak this spring. It started. But two things would flip this. Watch them both. 1. A real deal, not a memorandum. Sanctions relief traded for the toll system's abolition, with escorted lanes underwritten by the insurers. If Lloyd's prices Hormuz like a normal sea lane again, reopening accelerates fast, and oil gives back most of its spike by winter. 2. Demand cracks first. If prices grind toward $200, recession does what diplomacy couldn't. And if China starts draining its 1.4 billion barrel reserve in earnest, the pressure that forces a deal evaporates. Then this doesn't end. It just grinds on at a lower boil for years. No deal? No demand crack? Then everything you just heard gets worse by 350 million barrels a month. The Strait of Hormuz was never just water. It was an assumption that the narrowest point in the global economy would always stay open, because it always had. That assumption is gone, and the next one to fall is already on the map. Last week, we showed you how one company's centrifuges hold America's nuclear revival hostage. Same playbook, different fuel. It's on screen now. Follow the chokehold. We'll be watching the next pressure point.